Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for October 12th, 2020. Disclaimer for important information. Well, here in our weekly COVID tracker report, you can see that really dating back to the beginning of September, we had a rise in 7-day moving average case volume for coronavirus. But at the same time, we've seen positive trends continuing ever since July in the treatment protocols that are being applied to those that are showing up as infected. As you can see, the 7-day daily average of deaths continue to go down. So that's a positive. Here in our high frequency data, you can see that we had a little bit of retrenchment in the last week, and frankly, over the last month as well, as we've seen some of these cases rise, and we've seen some jurisdictions clamp down on in reinstating restrictions and such. But really, if you look at the TSA checkpoint data, we're getting more travelers out there. That number is actually fairly positive from a purely aggregate data standpoint. Motor gasoline, we've got more road miles traveled, so that's a positive. And then in some of the more manufacturing oriented things like rail car traffic and steel production, we can see shipping is just barely moving over the last week, and probably a little bit better data that we've seen over the last month. But if you look at staffing and then obviously jobless claims, which we're going to talk about briefly coming up, those are also positive, but not as much leisure and occupancy in the hotel side. Daily rates are down and restaurant activity is down just a little bit over the last week. So this is something I think is worth noting here, and many of you have probably seen the data and read about this, but it's really not getting a lot of press because we've got the election at our backs, and we've got a lot of other things here domestically that we're talking about. But it's important to recognize here that while we're having this bit of chop with our coronavirus problem, as you can see that ever since the end of August, I mean, we've seen a fairly dramatic spike in caseloads in the UK in particular, and then also France and Spain. So this is kind of this European second wave, and you can see our bump happened a little bit earlier, but all of this data is tracking a little bit more negative here in our overseas markets. And obviously we watch this for the implications on European business climate and sentiment indicators, whether there's going to be increased lockdowns and things like that have been talked about. And obviously that will have implications on international investments and so forth. So we'll be monitoring that for sure. This is something I thought was very interesting from the compilation page that we get from First Trust every week. And this is actually real data from a sample size of 1,200 schools, elementary through high school, on a national basis. And you can see the infection rates are much, much lower than I think, maybe some press would have you allow. Again, I'm not a conspiracy theorist here. I'm just saying that the data is suggesting that the infection rates are not nearly as much as had been feared. Now, that's not to say that there are certain schools, certain geographies that have witnessed more than their fair share, but overall, it's really not been as pronounced as people had thought. This is something I thought was really interesting, and it's a survey of Cisco. And what this really represents is an indictment on the future of office. And I've read several articles on the future of office, and obviously there's a lot of rhetoric on whether people are actually going to be going back to the office en masse, and a lot of firms have already said that part of their workforce can stay home permanently. But this is pretty telling here that the new normal that these nearly 1,600 respondents have said that the new normal, with 90% of them saying that they won't return to the office even after the pandemic is over. So obviously implications for real estate investment trusts that hold commercial income properties. Obviously there are implications for development, along those lines. And that's not to say that office space is going away, and because that's not certainly the message here, but just that that there's going to be stress in that market well into 2021 and 2022, and maybe even the year after that. This is a quick chart, a little bit noisy, but it just kind of shows you where the race is in terms of a vaccine. And just this week, Moderna, which is that second line there, they're out of Massachusetts, and they've said that they're not going to basically put patent boundaries around their medicine. They're going to license it out while the pandemic is still going on to try to, get more production, get more distribution out. But that you can see that there's a whole litany of companies that are working on vaccines. The light blue areas represent where they're in phase 3 clinical trials. These are large-scale human trials that are really the last step before the body of work is submitted for regulatory approval. And you can see that there's a lot of therapies actually at that level. And usually this is what takes a long time because you're dealing with literally thousands and tens of thousands of patients, and everyone is scrambling for available case studies, people that have coronavirus and whatnot. So, and there's a bit of a mixture here between the actual vaccine and there's also some of these companies are working on basically antibody, serum-based therapies that are trying to, also hit the market. So interesting to watch this as it continues through the fall and certainly well into next year. Another trend that we're following is this, this whole notion of deglobalization, and this is, something that's really taken root, over the last several years. And you can really call it, kind of at the advent of the Trump administration. You could see, a lot of backtracking and a lot of, breaking down of multilateral trade pacts and agreements, and kind of a more of a desire on one-off unilateral agreements, between two countries. And so you can see clearly here this undertone of animosity that's building between the U.S. and China, that in that upper chart you can see, already moved. You've got a large number of companies that have already moved some production out of China. In fact, this UBS, which is a large investment bank, the slide comes to us from PIMCO, but it's UBS research. 60% of respondents plan to move or continue to move production out of China. And that's pretty profound because that's going to have a lot of downstream implications, as far as cost of production and things like that. We've got a slide coming up to kind of hit that. But clearly, China has, long, touted itself as a low-cost manufacturer, and that's why people want to move there, right? Because it's a, for publicly traded firms, it provides them low-cost manufacturing, which drives earnings, which drives investor sentiment, which drives share price. So, but we've clearly seen, the downfall of that when you've got supply chain disruptions because of a pandemic, and so you're exposed on your flank, and you're basically, as I like to say in the banking world, you're as strong as your weakest link, and we found some weak links. And I think there's, not only is there deglobalization going on and more almost this national pride type of thing going on, but there's also some strategic implications that are driving people, to onshore and maybe find other, less contentious areas to manufacture. But down below also, just as a side note, it's not certainly not unworthy of mention here that the attacks on the World Health Organization are clearly having an impact on the approval rating for that organization. And suffice it to say that there have been missteps in communication and reaction times and so on and so forth by a lot of people during this pandemic. So continuing with this theme of China and sentiment, we have followed this for a while, and you can see this data even, beginning with some of the trade spat when even before tariffs, there was negative rhetoric. And you can just see in that circled area, on the left that the unfavorable sentiment here is just continues to go up. And again, we've shown this to you before, but it continues to track north. And, even in this election season, we know that both parties, are going to have, dramatic animosity or harbor animosity towards China. And so I think China policy is going to continue to become very acrimonious and perhaps even a little bit toxic. But you can see that that there's really no party delineation. If you look at that on the right, both parties are clearly, harboring unfavorable opinions of China, and this is going to have some clear policy implications regardless of who the next president is. So on the other hand, this is kind of evidence of what China is doing in its 2025 initiative and being a world global leader in the manufacturing and strategic areas. And one of these areas is clearly semiconductors. Now, notwithstanding the fact that China has a claim on territorial rights on Taiwan, Taiwan has long been a very strong center for semiconductor manufacturing globally. And you can see, whether it's Taiwan, South Korea, even the U.S., Europe, globally, you can see that from 2020 to 2030, that the share of semiconductor manufacturing is going down in those areas, and it's spiking in China. So when you think about, the digitization of everything that, is in our lives, and in particular automotives, whether it's the gas-powered engine or it's the electric vehicle, you're seeing a clear increase in the concentration of semiconductor components in those cars, and sensors and computers that calculate, various things that drive messages that you see when you drive your car and such. But China is going to be an increasing a component of the global semiconductor manufacturing landscape. And, in light of the charts that I just showed you on this unfavorable sentiment, this is going to cause a clash of a lot of things that we're going to have to pay real close attention to, supply chain disruptions and whatnot. We've seen a rapid decline in exports from China of what we call rare earth minerals. And these are, as the name would suggest, they're rare, but they're minerals that are essential components to a lot of technology. Even in desktop computers, there are certain components that are rare earth components that are needed there. And a lot of this production is in China. But we've seen a lot of export decline. I didn't show that chart, but perhaps in a later pack we can do that. But that is just another clear signal that that technology companies might have a little bit of trouble looking over the long term in securing critical components and supplies. This is the chart that I referred to before. Now, China's long touted itself as being a low-cost producer, but you can see here, and this is from the Financial Times, that Mexico is, really kind of usurped kind of the juice, if you will, that China brought to the world when it, opened its borders to manufacturing and contract manufacturing. But Mexico here has a clear advantage, as do some of the other Asian countries that currently don't have a contentious relationship with the U.S. And it's long been understood that Mexico offered advantages for manufacturers, not only in terms of geography but also in cost. But China continues to increase its cost of production, and has frankly made Mexico much more strategically viable, if you will, for a lot of domestic companies. So, that's one area that I would say would benefit, particularly with the revised free trade agreements that have been negotiated during the Trump administration. This is a slide going back to China for a second of the U.S. dollar relative strength against the Chinese currency, the renminbi. And this is inverted, which means the dollar is weakening. So as that number goes up, that just means that the dollar is buying less and less of the Chinese currency. And when you think about it, the U.S. is a cheaper currency. That would tend to imply that U.S. exports to China would be cheaper, and vice versa. The U.S. imports from China would be more expensive. And we know that in some areas, like say for beef, actually, exports to China have been fairly strong, but in other areas, and certainly in terms of, net trade between the two, I mean, it's clearly gone down. But the U.S. I highlight this just because it's interesting that we've seen such a pronounced move in this in the exchange rate here, and some of it has to do with the fact that our interest rates continue to go down. Chinese interest rates are still, I think, 10-year Treasury is still above, or the 10-year renminbi Chinese bond is over 3%. So clearly a differential there that's driving strength in their currency. This is just a quick update, kind of tracking back before the beginning of the decade on the Global Economic Policy Index. And this is something that we watch, as a backdrop to what the global investing climate looks like. And so, clearly in 2018 and in 2019, that policy uncertainty index continued to spike. And a lot of it had to do with the fact that there were, tariff wars against China, a lot of trade, breaking of trade pacts. I mean, a lot of this had to do with what was going on and kind of the strategic ploy by the Trump administration. But really what it did is cause a lot of international investments to become less attractive and lose their catalyst, even though they're, in terms of pure value, they have a lot more attractive qualities and just in terms of valuation than the U.S. market. But what we're seeing here is that in August 2020, if you just look at the 2020 in a microcosm, you can see that uncertainty index peaked during the pandemic, the height of the pandemic, and it's come back down, but it still remains fairly elevated. So there will be a trigger point to get back into and increase your allocation into international equities, but it's probably not right now, especially considering the slide that I showed you on infection rates going up in European markets and such. But this will be one that we will continue to watch as a signpost, perhaps, on getting back into a bigger allocation in international. Fiscal stimulus, I thought that this was really poignant because what this shows you is that if you take the large G4 economies and you add China to it, it just shows you the magnitude of fiscal balance. And this is basically a negative percent of GDP. And the numbers themselves are very large and have lots of zeros behind them, but the percentage decline or the percentage increase in the fiscal imbalance is particularly striking. And this is something that just, to keep in the back of your mind that these things don't, work themselves out, immediately. Now, you can see that if we've gone back to the global financial crisis, that globally amongst the largest countries that you've had fiscal deficits, but nothing like we've seen this year, and that will probably help keep a lid on overall growth as we move forward. And this is a slide just kind of focusing on the U.S. for a second. With that last slide as a backdrop, you see that, in crisis periods, if you look at the, during COVID, we had a negative 29, and actually that number was at, point to point, peak to trough was closer to 34%. But, we had a 10-year Treasury rate go down just over a percentage point. Rates were already pretty low. In the global financial crisis, we saw a much larger drop in the market, but we also saw a larger drop in interest rates. And then in the tech bubble in 1999, heading into the new millennium, you could see those numbers are fairly dramatic. But where we stand today, with what's already been done in fiscal stimulus and in monetary policy and reducing rates, you can see that, with the 10-year Treasury already at 0.7%, that's pretty much all we have to go. We don't really know what the S&P return is going to be. Perhaps there, and I tend to agree that most of the damage was done earlier this year, and obviously we fought back. But there's clearly some, some issue, some risk here that if for some reason, there's a policy mistake or there's a second wave which causes a retrenchment in the economy, that it doesn't leave us a lot of seed corn to manipulate interest rates before they go negative, which is something that has happened certainly globally. And we've had, anywhere between 10, at any one time between 10 and $18 trillion of global debt that's been priced at negative yield. But we certainly don't want to do that here in the U.S. With the dollar being the reserve currency of the world. A little waxing on small business, which you've heard me talk about a lot. This kind of hit me from Alignable. Again, these numbers, if you look at all of these different industry segments, these are clearly areas that have been most impacted by the pandemic and shutdowns. But you can see that a lot of people aren't paying rent. Again, remember what I talked about with regard to commercial real estate. Not only do you have people that are not going back to work, and perhaps companies and larger companies not needing as much real estate, but you also have small businesses that are really struggling to pay rent right now. And I think this chart is really poignant in the fact that it polls 7,700 small businesses, and this is really current data. This is really as of the end of last month. So something that I think we're clearly going to have to pay attention to, particularly in the fourth quarter as we head into next year. So we'll talk about unemployment and employment. Clearly we've seen this continued kind of gradual decline with the exception perhaps of July, which is a little bit of a bad month in terms of progress was concerned. But we're about 800,000 on new initial claims, which is still far elevated above where we were back in January. But you can still see that there's still pandemic initial claims, PUA claims that are coming in. And so, while that number continues to mitigate, and it looks nice on this chart, but it's still very high in aggregate terms relative to where we were back in January. So as we transition from initial claims, these are long-term claims. These are truly displaced workers. These are workers that have been unemployed for more than 27 weeks. And you think about, a 52-week year. I mean, this is a long time. And, it takes a while to work this number out because you, in many respects, and there's a slide coming where you see the differential between kind of socioeconomic layer, that a lot of these people are low income folks and skills. And the longer you go, the less marketable you are to get back in the workforce. And so the risk here is you have more of these long-term unemployed people that are clearly just going to have a hard time reintegrating back in the workforce. But ironically, and I saw the chart on this, but I didn't include it in the pack. The irony is that, with so many people displaced, even though they're getting $300, not $600 of supplemental coverage, that there are actually a fair number of job openings that can't be filled, despite what you see on your screen here, which is really kind of an odd situation. And even dropping that benefit from 600 to 300, you would think would get more people back into the workforce, but that actually hasn't been the case thus far. So again, employment trends are really a bit awkward right now. But this is a number that, when things do settle out, it's going to take a while for itself to work down from these levels. This is the chart that I mentioned a second ago. This is the unemployment rates, basically the drop in employment, if you will, based on these socio-economic layers. And clearly the impact has been on the trades. It's been on, the things, jobs that are impacted by shutdowns the most. Obviously, white-collar jobs, people work from home. That's not necessarily an issue. But if you're, in shipping and distribution, you work in a restaurant, you work in a warehouse, and you're shut down, well, that's a huge impact. And you can see that the dislocation has happened at the lower socioeconomic levels. And even though, we've seen battling back in all of this, you can see the tremendous destruction in labor that we've seen in less than high school diploma and high school graduates. Again, that it just takes time to work it out, and we've made a lot of progress to September. But I think, depending on the pace of a vaccine, it really could take a while. And I don't know that we're going to see, those lines on that chart that are moving up and to the right, or they're going to move at the same pace over the next 6 months as they have, in really the last 4 to 5. We'll check in here on loan delinquencies, and this is something I'm really kind of concerned about. We've had a lot of people. We saw last week where a lot of business owners were using credit cards to make ends meet and to get by. So we've had a lot of credit card usage, and that usage has kind of come to a stop. But we see these delinquencies go up. We've seen auto loans for a number of years just kind of eke up. And they're really above where they were, at the height of the post-global financial crisis area. Now, mortgages, very positively, those are not tracking too bad. And then that big drop in that purple line, those are student loans where there was a federal forbearance provided for, roughly till the end of the year for student loans. But you'd expect to see that number probably bounce back when students are then, or post graduates are asked to, begin repaying those. But overall, credit is kind of a mixed bag. Good to see mortgages not so high, but that's something that could turn fairly quickly, just as we see business owners struggling to pay rent. You're seeing homeowners, to the degree that we have a higher or elevated unemployment level for a prolonged period of time where we're not getting additional federal stimulus, you should definitely probably expect to see that number begin to eke up. But again, we'll monitor that, and we'll see those impacts probably manifesting towards the beginning of next year. Active forbearance plans. This is just, forbearance on mortgages, and a lot of these had a fixed initial term of like 6 months, and we're coming to the end of a lot of these mortgage forbearances, and so we're seeing that the actual forbearances are going down, and so that's now pushing the onus onto the homeowner or the mortgagee, if you will, to begin repayment. So as these numbers continue to slide down, we're going to have to watch that delinquency number to see if it goes back up. Consumer comfort, we've seen it pick up clearly from May. It's a trough level. It's below where it was before the pandemic. We know all that. July, we had the caseload increase. We had this shock effect of, oh my goodness, we've got more coronavirus cases. I thought we were through the crux to this. So, it went down, it went back up, but we've seen a little bit of leveling off in consumer comfort. And, this is really going to be important to measure next month. And we won't get that data till December, but, as we head into holiday shopping, and we know that people are going to be shopping much, much more online than in stores this year. So, the question is, how do they feel? What's their comfort level? What's their personal finance, position? Are they going to be able to shop? Because we really need to see kind of some positive read-throughs on holiday shopping this year to give our economy a boost. This is a chart on kind of the health of the average investor and health of the average household, frankly. But, this just says that, more than half of people that are in that pre-retirement phase had more than $100,000 saved up, before COVID. And, I think this just really drives a point home that that it's going to be tough for a lot of these people to retire because this is not going. This is money that's clearly not going to last. So it's going to make them much more dependent on handouts, make them much more dependent on Social Security, which already I've got a chart that I didn't include in this pack, but 2032 now is the magic year in which the trust fund is supposed to exhaust itself. And so, the burdens on society that is already tremendously leveraged, having aggregate debt, well now above 100% of GDP is clearly going to be a societal burden that we're going to have to wrestle with because it's clear from this chart that you've got a lot of people that will be entering retirement, within the next, 6 to 15 years that are not adequately prepared for it. Little conversation here briefly on business investment. I think it's intuitive to understand that working from home, that trend, even though we had a shutdown, that a lot of people needed to invest in technology, bandwidth, better equipment, so on and so forth, software. IT spending from a business perspective has really picked up, and that's been the kind of the bell cow of business equipment spending here year to date. Meanwhile, we've seen a tremendous drop off in business-related equipment expenditures, and kind of this basically non-construction related spending has really dropped off. And so the question is, when does that begin to turn? When do executives who are already, and we've seen this, as CEO sentiment is actually much higher than investor or consumer sentiment is, but yet it hasn't translated into spending. And that's where we really see kind of the proof in the pudding, if you will, in their confidence in going and spending more. In this chart, a little bit noisy, but on the top hand side, this is a Goldman Sachs forecast. It shows that they actually do expect that business investment will grow about 5% next year, and then kind of spike up and then kind of level off over a period of years. That's good. We want to see that. On the bottom, this is non-residential fixed investment. So this is like, fixtures and, permanent type of additions other than maybe equipment per se, that, we've had such a dramatic fall that it's going to take us really about, in the second half of next year to really kind of recover. Inflation. There's a lot of components to inflation. I think the main takeaway here is that, even when you decompose the components, and we know that owner's equivalent rent and rent that's paid is typically about a third of inflation. And then you can see these other components, mobility related, et cetera, that inflation is really sliding off. And we had a little spike in July, but overall inflation is really, really tame right now. And a lot of speculation over whether we're going to get inflation. I think it's a question of when, not if. But I think the question of when is, with this kind of data as a backdrop, I think it's pushed out for a period of time where we're not going to have to worry about inflation here too much over the near term. And indeed here we see that 1 year inflation expectations, which spiked with all of this stimulus, it's gone really right back down to a trend line that's been consistent over the last several years. So 2.6 is the latest University of Michigan in 1 year forward inflation expectation, and I wouldn't be surprised if that would continue to fall. Housing inventory. Well, we know that the bright shining light of the economy this year has been housing. And if there's one chart that I can show you that speaks to kind of the health of the market, at least from a price perspective, it's this one. This is the median days on the market, and this is a national chart. So what this is telling you that we've got basically about 55 days of inventory. You can see the seasonal fluctuations here in the market, but what this is showing you is clearly that inventory levels are down, which should helped to support prices. Again, this is national, so it doesn't really speak to each market individually, but it's a pretty powerful statistic. If you think about housing being the majority of a typical household's net worth. This is an inflation chart over a long period of time, dating back, frankly, before the Great Depression. And all I want to do really with this is to have you focus from the mid to late 70s. We had the OPEC embargo, we had stagflation, then we had hyperinflation before the Fed really took a stand at the advent of the Reagan administration, and really just kind of look from 1980 on. And what is really clear here is that the inflation on a trend line basis has actually gone down over time. You see the noise there a little bit. Obviously, we had a spat of deflation during the global financial crisis, but over time, trend line inflation as a percent has actually gone down, and we're at a low point that we saw briefly at the middle part of last decade. But we're clearly at a low point for inflation. This is the S&P 500 market. You can see that we've kind of reestablished that trend line that brought us. This is a short-term trend line, but clearly September. We had a little bit of chop. We had a little bit of retrenching. We had a little bit of leadership change, or maybe a tweak in leadership as some of the large FANG stocks sold off, and we're heading into an earnings season here that's going to be really critical from an optics standpoint. What are the CEOs going to say? How confident are they? And we expect a lot of CEOs to either withhold guidance or temper their guidance looking into 2021. But you can see that heading into earnings season, there's a lot of optimism here. So I just want to say that we've got a lot of risk on the margin, and the market is hitting a high, and some of the internals just seem to want to suggest that we'll get a little bit of chop in the market here. This is something I wanted to show from a planning perspective, and this is actually a really kind of noisy chart, but if you look at the top of each of those vertical bars, you see the year. And so this goes back to 2000. And the challenge from a financial planning perspective is that from 2000 to 2020, you can see that, more of the components, and these are everything from bonds to domestic stocks to international stocks to real estate investment trusts, emerging markets, private equity, hedge funds, all of these different components and asset classes. But what is clear in this that that red line is a 7% nominal return target. And if you think about financial planning, going through that exercise, one will assume that we've had, that this 60-40 portfolio, should generate something, close to that. And I think the challenge that we're going to face over the next decade is going to be that more of these asset classes have been posting returns below that. And so you're going to have to get more creative and think outside the box and think in terms of availing yourself to other investment opportunities. And here at BKA, we've certainly been trying to do that with things like structured notes and fund of funds and things like that, because clearly there's been more stress on the ability here over the last several years to generate that 7% return based on the available set of options. And to wit, I offer this little nugget to you, and this is actually from FS Investments, but it's data from Bloomberg. And what it shows you is that back in the 1990s, most of your return from bonds came from the income, from the interest. Very little came from price return. As we move from the 2000s to the 2010s, and certainly last year, that much more of the fixed income return, if you think about, equities being 60% of a traditional kind of slightly growth-oriented portfolio, and then bonds being 40%, that much more of the return here lately has come from price return as interest rates have gone down, and so you're not getting as much income return as you have been in the past. And the implications of that are that you're going to have bonds that are going to potentially be a bit more volatile going forward. So I think it's really incumbent upon us at BKA to watch where we're going with fixed income, watch the price risk that is inherent with fixed income instruments that have more of their return coming from price movements as opposed to the income. So something we'll have to monitor. This is something that I just want from a planning standpoint to emphasize, that if you look at 1 year, that your variability of returns is fairly wide. Now this is S&P 500 quarterly returns going back over several decades, and that you are going to have a wide variability if your investment horizon is only 1 year. But if you extend that out into 3, 5, and 10 years, that becomes a lot better defined over time, even though your rolling median return doesn't change that much, but your certainty certainly does. And so when we do financial plans, obviously we're thinking about long-term investment horizons with this in mind, so that the standard deviation or the volatility of returns goes down dramatically the longer that you have the luxury, to plan for. And with that last slide, I just wanted to offer this from Statistica, and this is a question that was asked of folks with the pandemic and as a backdrop. And a lot of people are concerned about a recession. I think that's fair, maybe not terribly well founded, but it's a fair critique if you're an average investor to look at the landscape and say, well, I think there could be a major recession. And then obviously the impacts of COVID are having a negative impact on financial planning. So, and then feeling unprepared. I mean, we've seen the data. We know that, there's a lot of pre-retirement people that aren't prepared, and clearly that's being reflected in sentiment numbers. So it's really a critical juncture for financial planners to walk through and be very diligent and thorough in the planning process, to kind of walk people through this psychological burden that they have with regard to what they hear and what they see, and their own perceptions, and as well as their own fears of not being prepared. So I mean, this is a real high time for financial planners. Well, that represents the bulk of the charts this week. A lot of good data this week, and I hope you've enjoyed it. Certainly welcome your comments and questions, and at the information you see here. I hope you have a safe week. Have a great week, and we'll see you very soon. Take care.